So let's go through the notes on IFRS 16. A lease is an agreement whereby one party is known as the lessor, not leaser, the way some people call the correct pronunciation is lessor, conveys to the lessee in return for payments or series of payments the right to use an asset for an agreed period of time. The right to use the asset for an agreed period of time. So a lease is a contract between two people, the owner of the asset being called the lessor, and the one being given the asset known as the lessee. So the lessee should, let me mute everyone. The lessee has an obligation to make payments to the lessor for the agreed period of time. The agreed period of time in this case is known as the lease period. So key terms, we have some terminologies here. Commencement of the lease term is the date from which the lessee is entitled to exercise the right to use the leased asset. So the date when the lessee has the right to start using the asset, that is what we call the commencement date. Then we have inception. Inception of the lease is the earlier of the date of the lease agreement and the date of commencement by the parties to the principal provision of the lease. So inception comes before commencement. So inception is the date when they entered into the principal provisions of the lease, that the lease will take this period, this is the amount you will pay, then they enter into that contract. But once the asset has been transferred to the lessee for usage, then now that one we talk of commencement. So inception comes before commencement. Then economic life is the period over which an asset is expected to yield economic benefits to an entity. Of course, that is the useful life. Then we have contingent rent. For your information, the amount lessee is paying the lessor, for accounting purposes, that amount will be terming it as the rent. So it will be rent paid or rent received, depending with whose books you are dealing with. In the books of the lessor, we'll be talking of rent received. In the books of the lessee, that is rent paid. So a contingent rent is that portion of the lease payment that is not fixed in amount, but which is based on certain future factors, e.g. percentage of future sales. You know, the word contingent always means subject to. Word contingent means subject to. So when we talk of contingent rent, there is that part of the lease which the lessee will be paying, but subject to certain future factors. We agree that I'm giving you this asset on lease term on condition that if sales goes beyond this amount, you'll be paying this amount. So in a lease, if the rent is based on some factors, then that is called contingent rent. So you can have the normal rent, and we have at the same time contingent. You pay me 20 if it is below 1 million. If your turnover goes beyond million, you will add me 5. So 5 is the contingent rent. Gross investment in the lease, it is the minimum lease payment receivable by the lessor under finance lease and any unguaranteed residual value accruing to the lessor. So when we talk of gross investment in the lease, gross investment, you know, lessor has invested. That is the true fact. The lessor has this asset for investment purposes to give it out and be receiving returns. So the amount they receive That is what we call the gross investment, the amount unapokea. So, and we have said including unguaranteed residual value. So the next question is, what is unguaranteed residual value? It is the portion of the residual value of the leased asset on which the lessor is not assured to receive at the end of the lease term. So at the end of the lease period, the lessor can have an agreement with the lessee that you will give me this terminal amount. So the terminal amount it can be certain or it cannot be certain. So if the terminal amount is with uncertainty, then we call it unguaranteed. While if there is certainty, then down there, the next number, we call it guaranteed residual value. Is that part of the residual value that the lessee will have to pay the lessor at the end of the lease term? So that one is fixed in the contract, that upon the end of the lease period, the lessee will have to pay this amount at the end of the lease term. Then that is called guaranteed residual value. Then we have interest rate implicit in the lease. Is the rate of interest that the lessee will have to pay, having taken into consideration the present value of the lease payment. So interest rate implicit is just the finance charge or finance income in the lease. Because if you have a lease, there is always even the incremental, the annual incremental rates. So even landlord, if you delay paying, you will be paying back with this interest. So for leases, there is always that interest factor. And the interest factor is always calculated as a percentage of the opening balance, the balance brought down of the principal. So the interest which we subject the principal to, that is what we call the interest rate implicit in the lease. Then we have lease incremental borrowing rates. Is the rate of borrowing on similar terms and on similar assets. No problem. Let's go to the types of leases. So we have two types of leases. We have operating and finance leases, those two. The major classifications are those two. We have operating and finance leases. So allow me to start with the finance lease. A lease is classified as a finance lease if it transfers substantially all the risks and rewards incidental to ownership to the lessee. So a lease whereby mostly the title of ownership is transferred to the lessee. So such kind of a lease, in a finance lease, the title of ownership mostly, though not always, but mostly, I will even say 99% is transferred to the lessee at the end of the lease period. For example, sasa umemaliza shule, uko na calculator and you want to, unataka kupea mtu, unamwambia kila siku utakuwa unanipea 20 bob for using my calculator for 1 year. After 1 year, you cannot tell this person after 1 year, make sure you return my calculator. Unamwambia ulipaka hiyo 20 bob, mwaka ikiisha, unilipe 50 terminal cash flow. Then you'll be with that calculator. So that 50 is called guaranteed residual value. Then the 10 is now the installment. Then I charge this particular interest. So where you agree that upon the end of the lease period, the asset will be retained by the lessee, and the retention here is in terms of ownership, that is called a finance lease. So let's check some of the characteristics of a finance lease. Characteristics of a finance lease. It transfers ownership of the asset to the lessee by the end of the lease term. That one we have discussed. And that is the main characteristic. And the reason why these characteristics are very important, in a question setup, the examiner might be very rigid in saying whether this is a finance lease or an operating lease. So the main feature of a finance lease, which will help you to identify very fast that it's a finance lease, is the fact that the title of ownership will be transferred to the lessee at the end of the lease period. Number two, the lessee should have the option to purchase the asset at a price lower than the fair value at the date the option becomes exercisable. Because if you're telling me at the end of year 5, I will have paid you this, we know the installment, and the asset will be retained by me, we can have the option to purchase it right now because we can project based on the installment. Then you can allow the lessee not to purchase it at the current market price, but at a price which you can negotiate with the lessee. So the lessee is always given an option to buy the asset because we know the title of ownership will be retained by the lessee at the end of the lease term. Then number 3, the leased asset should be of a special nature such that the lessee can use them without major modifications. Hapo hakuna much discussion. It should just be in the right condition of usage. Then the last, the lease term should form a major part of the economic life of the asset, even if the title is not transferred. What that means, the lease term to form a major part of the economic life of the leased asset, what it means, if the economic life or useful life of the asset was 10 years, and by the time you are getting into this contract, 3 years had already elapsed, and the remaining economic life is 7 years, let the lease not go past 7 years. The lease term should be 7 years or below. So the lease period should be equivalent or below the economic or useful life, the remaining useful life of the asset. If you go back 7 years, then the lease is talking of 10. It means you will be utilized, the lessee will be using the asset when the asset is now considered to be worthless. So for finance lease, the first one is the one which is very important for us. Let's go to operating lease. Is any form of a lease other than a finance lease? Actually, that is how the standard defines an operating lease. Even if you check, the standard defines an operating lease as any other form of a lease other than a finance lease. So any lease which you know, that is apart from finance lease, where the title will not revert. So regardless of the conditions, that is an operating lease. But when we scale it down, it says the title of ownership is retained by the lessor during and after the lease period. Correct. So some of us are in the rental houses in the urban areas, which is of course global. So the houses we rent in the urban areas or wherever you rent them, all of them are on operating lease, unless kuna hii ingine imekuwa na two issues, the one you call rent to own. Rent to own, sometimes it tends to be classified as a finance lease, but usually we are not dealing with those rent to own here. So those rental houses in the urban areas, they are on operating lease. You cannot tell the landlord that I'll be paying you rent here of 10,000 every month. Then after 5 years, this house can be mine because that is an operating lease. The title of ownership will revert back to the lessor, who is the owner of the asset. Such kind of a lease is known as an operating lease. Risk and rewards are not transferred to the lessee, and all the incidental costs are to be incurred by the lessor. Yeah, that is true. Something which, before we proceed, I want to maybe who student that one, I don't know. Finance lease is also known as a capital lease. So when you will be writing those notes, the other name of finance lease, is also known as a capital lease. Maybe you can note it somewhere casually. Finance lease is also known as a capital lease. So take that note. NB, there is NB down there. NB. In the new standard, i.e., that is IFRS number 16, we were not applying IFRS 16, we were applying IS number 17. Yes. IFRS 16 came to effect from 1st January 2019. That is when it was rolled out for application. So it's very new. So in the new standard, IFRS 16, both operating and finance leases are accounted for as, in quotes, finance lease. However, the lessor is expected to account for the leases separately. What is not happening in this Zoom? So that is very important. That is very important. That is very important. And now that is where we have to understand and understand properly. In the new standard, and please, I'm talking to some very senior accountants here, and even some people who do audits. So this is something now, let us step out kidogo. Let's step out kidogo of the class part of it and be very, very practical. Many accountants are failing to check the provisions of this new standard. Many. And it is something which you can do. What happens with this standard? Initially, operating leases, people were not giving much time. Because operating lease, let's say your company, you are operating the offices or go down or factory, whichever, from where you operate on a lease premises. So what most accountants are doing, I've said now we have stepped out of class kidogo. What most accountants are doing, when they pay the rent for the office, they credit the cash book, they debit rent expense account, and the story ends there. Nothing takes place after that. That is what IS 17 required on operating leases, that the lessee should credit the cash book and debit the rent expense account. That was perfect. But now, with the introduction of IFRS 16, that is not the case. For finance lease, since there is expectation that the ownership will be retained by the lessee, you recognize that asset in the books at the earlier stage. Earlier stage means once you acquire the asset, you need to start recognizing it in the books because there is anticipation that this asset will be retained by you. So for finance lease, since the time immemorial, the lessee was required to recognize the finance lease in the financial statements. But now, in the new standard, both of them, both finance lease and operating leases, should be recognized in quotes as an asset in the books of the lessee. And maybe someone is asking how. So if you are operating, because we are talking of commercial returns, for commercial returns, when you are operating on someone's premises of which you are on a lease agreement, you need to recognize such agreement as an asset in the financial statement. So someone will be asking, how possible is that? What happens, let me give a very good practice scenario, where destiny is created. Of course, that is not our premises. It is on a lease agreement. So you estimate, you as an accountant, you do an estimation that the lease is going for, let's say, 10 years. And in the 10 years, every year we are expected to pay this, that, and that. So you can estimate that by the end of the lease period, we will have paid, let's say, 30 million. So this 30 million, you should recognize that in the financial statement as an asset and obligation at the same time. So it is an asset, but you don't recognize that the building. You know, again, when you go to IS number 16 on property, plant, and equipment, the asset which you recognize should be asset which is owned by the company. But you see here the title of ownership. Of course, it will not even come to you at the end of the lease period. So we don't recognize the word premises or building in our financial statement. And it's something, if maybe you are the accountant or auditor or somebody, make sure you put this in the practice. So what you do, you will recognize what we call right of use assets. In fact, can somebody Google check for me and you copy paste so that I can read from your Google platform? Can you check for me the meaning of right of use, commonly known as ROU, right of use asset? Just type this word, right of use assets. Right of use asset. What does it mean? Somebody can Google, then just copy paste. We read. That area is very important for us, practically and even for exam purposes. I'm waiting for someone to paste. We read what it means. I elaborate again, then we proceed. Thank you. So someone should not copy paste again. Kelvin has done it for us. So I read, and you can also check what he has posted. It says a right of use asset, also known as an ROU asset, is a key component of the lease accounting under accounting standards. That is IFRS 16. It represents the lessee's right to use a leased asset over the lease term. So when we enter into the agreement, hiyo kitu mnaandikana kwa agreement wachana nayo, ile kitu mnaandikana here in, there, off, wachana na hiyo. The agreement here we are taking in terms of the obligation that the lessee will pay in installments, and the obligation total should be 30. So this 30, yes, it's an obligation to us to honor the payment. At the same time, our right to use the asset when quantified in monetary value is this 30 million. So that is our right of usage. So that right, remember, right is an intangible asset. We talk of even the others, the copyrights, the trademarks, and the rest. So your right to use the asset should be recognized. That is why those people brought this new standard. That is why IFRS 16 was brought by the board. That this person will honor the payments. Then that amount to honor, that is your right of usage. And a right, by extension, a right is like an intellectual property. So we need to bring it in the financial statements. So for the lessee, regardless whether the title will be transferred to you or not, and when I say or not means operating lease, you have to recognize both the assets in the financial statements. Very important. So for finance lease, you recognize the asset itself with Ukitaka. But for operating lease, you recognize ROU, the right of use assets in the financial statement. If the asset is depreciable, just depreciate it as time goes by, then your right of usage will be decreasing as time goes by. And also, you will be amortizing. You amortize the lease as time moves. up to the end of the lease period. So if you are in charge of financial statements, maybe some of you are bosses, some are accountants, make sure this thing is captured, is taken into consideration. I realize most people are not doing. I find, you know, me, my main area is auditing. I do audits. Actually, that's my daily work. I realize most people, accountants, or taking your story, is something which is very easy, something you can do. You know how much you are paying on daily, on monthly, annual basis. Just get that whole amount, then you recognize the right of use. You'll be complying with what the standard requires. So, and also if you are not in charge of the books, on Monday when we go back, tell the accountant, can I have a look of the audited financial statements for the previous year? Then tell the accountant, why was the right of use asset not recognized? I believe that what is that? Mwambie refer to IFRS number 16. Anyway, hizo ni story mingi. Accounting for finance leases by the lessee. So how should the lessee account for the leased asset? So upon lease commencement, a lessee should recognize a right of use asset, that one we have said, and an obligation in the statement of financial position. Right of use asset is considered to be the value of the leased asset less accumulated depreciation. Depreciation will come as time goes by, but at inception, you just recognize the whole amount. Steps of accounting for finance leases. So step number 1, you identify the lease. No problem, you are in an issue. Determine the present value of the minimum lease payments. You know, you are telling me that I'll be paying 1 million every year for the next 10 years. So you one, you know the one you will be paying in future. You discount them to present. So when you discount this one to present, you will be able to say it is based on what principal amount. You know, you're telling me to pay 1 million for the next 10 years. So you, from your finance perspective, you know the value of money. So you discount that installment. Discounting will help you to check this 1 million is based on what principle. And remember that principle should be the right of use at commencement. So that is what you should do as your second step. Then number 2, compare the fair value of the asset and its present value. Then consider whichever is lower. So when you discount this 1 million for 10 years, and maybe your discounted is 9 million, then you check the market value. The current market value, it can be sold at 8 million. Then your right of use should be whichever amount is lower. You don't overstate the values of the assets. So once you discount your installments, you discount the installments, then there is the market value. You compare the discounted installments vis-a-vis the fair value, and we go for whichever value is lower. Prudence concept does not require overstatement of assets. So you go for whichever value is lower. That is noted. Then depreciate the value in step 3 above if the asset is depreciable. So if the asset is depreciable, whatever you have recognized here to be whichever is lower, you depreciate it. Then prepare lease amortization schedule. Then prepare the financial statements extracts. Full stop. Something of concern. This topic used to be in section 3. It only came in section 5 after the revision of syllabus in 2021. So since that time, those people have examined lease once. I think it is once. Kama kuna ingine nitaangalia kama na setting maybe. But I know there is one question there which cannot be sufficient for us. So I have some other questions in a handout. So I want us to solve those ones first. Then we can go to the past paper. So allow me to share the handout with you people. Allow me to share the handout with you people. So you can stretch a bit as I look for it. You can take hot water, not cold. Yeah. So I've shared in your group. Kindly check. Kindly check. Kindly check. So we want to go to question 1 of that handout. But then I'm really loving the cooperation in this class. Unajua when students cooperate, mwalimu anakuanga motivated. So kuamka 5:30 is not for everyone, especially, let me be very honest, especially mimi. Kuniambia hiyo 5. Unajua sasa hii naamka juu kuna motivation. But if people are saying, mwalimu, we just postpone. So congratulations. It is not easy to wake up. It's very difficult. Very difficult. So let's go to the handouts. Hizi vitu utapita tu. When we do them thoroughly. So allow me to read question 1. Allow me to read question 1. Sijui kama siku moja tupatane physically, all of us. You know, we need to know each other. Hii maneno ya mtu anatembea kidogo hautaki kulipa fare kwa matatu alafu unasikia nyuma mwalimu tulia tutakulipia is not very good. We need to come and see each other. Mwalimu anaweza kuwa anatembea mahali wewe unanijua na mimi sikujui, then you take now back seat. Let's read question 1. It says on 1st of January 2019, JM Limited leased a machine from JT, leased a machine from. So JM is the lessee. From JT Machine Limited under a finance lease agreement. JM Limited was to make installment lease payment of shillings 14 million. 14 million every 6 months. Every 6 months. Every 6 months on 30th June and 31st December in arrears. In arrears means after the usage. The first payment was made on 30th June. The first payment was made on 30th June and 31st December in arrears, right? I think there's a repetition there. because again the first payment, there's a repetition of that one. The fair value of the machine was shilling 60 million with an estimated useful life of 3 years. The interest rate implicit in the lease was 10% per 6 months, not per annum, 10% per 6 months. Required extract of the statement of profit or loss for the year ended 31st December 2019 and 2020, then extract of the statement of financial position. Extract inakuwa huko mwisho. You cannot manage to go to the extract straight away. There are some workings which you have to pass through before you get to those financial statements. So let's do some small workings. Number one is the lease identification, but there is no need of identifying the lease nowadays, by the way, because for the lessee, regardless whether it is a finance or operating lease, all of them have to be accounted for as if they are finance lease. You know, in a finance lease, you recognize the asset. So the identification does not matter for the lessee, but the lessor account for them separately. You know, the lessor is the owner of the asset. So for whichever, for the finance lease, lessor anajua the asset ownership itabaki na ule. For operating lease, anajua asset will come back. So to them, they can separate, but in the books of the lessee, and that is what the examiner normally focuses, there is no distinction. So I want us to work this in the books of the lessee, because if you check keenly, JM, the lessee is the main issue here. Then maybe the next question, I'll go in the books of the lessor so that we check how accounting differs. So step one, lease identification is not important. Step two is where I'm going to start, whereby we check the present value, because this person is telling us to pay 14 million after every 6 months for 3 years. So, just a moment. There is someone saying that the link is saying there is an error. Did you encounter problems logging in? There's someone chatting kidogo too that they can't log in, that there is an error with the, let me see. Kidogo too, there is someone offering answer there. No, it's okay. It is fine. So please allow me to call that student. Don't go to them. Just a minute. But the link is working. The Zoom link. Huh? Video, have you enabled your video? Restart, we just restart up the phone. Maybe you restart, then check whether your video is on. Sorry for that one. But I will share the recording, so no much problem as well. Sorry for that. So they are saying they will be paying 14 million after every 6 months. So you need to ask yourself, this 14 million, because after every 6 months for 3 years. How many 6 months are there in 3 years? 6 of them actually, because a year, 2, 2, 2. So there will be 6 of them. So you need to check. By the time I complete paying this 14, how much will I have paid? Kama si mtu wa finance unachukua 14 times 6 installments. But now for finance, we have to discount them to present value. So can you discount this 14? It is based on which principal amount? Because najua mtu atakukalculatea venye anataka ndio at least interest ipande. So check this 14 is on what principal amount. Then you compare. Currently, they are saying the fair value is 60 million. So you will compare the discounted value versus the market value. Then the value of the asset is considered in the books to be whichever is lower. So let's start by discounting. Present value of the installments. Present value of the installments. So installments, they say it is 14 million after every 6 months. So I will take 14 million times. Now remember, this is an annuity. So annuity, you know very well how we discount. 1 minus 1.1. I'm taking 1.1 because we normally take 1 plus R. And our R, they'll say 10%. So it is 10% raised to power -6. Why am I taking 6? You know, N is the duration. N is the duration. Duration was 3 years, but the 10% was not per annum. 10% was per 6 months. So in terms of duration, I will check how many 6 months. So in a year, we have two. So the 6 months, we have 6 of them. So N will be 6 because 10% is per 6 months. So I'm not saying 10% for 6 months, but for the 6 months in terms of the duration. In a year, 2. So 6. If it was for 4 years, then I will take 8. I will take per -8. So 10% is per 6 months. So you check how many 6 months are we considering. There are 6 of them. Divide by R, which is 10%, which is 0.1. Can you discount for me that, please? Kindly. Itapia hiyo maneno. Someone give me the answer for that. Whoever's discounted. We want to know it is based on what principle. Kwa nini wanatuambia tulipe 14? So you can see there. Jacinta, 60. So Jacinta is talking of 60. 973. 650 confirmed. Thank you. So for these people to tell us to be paying 14, they are basing it on this principal amount. So the present value PV is 60,973. Currently, the market value we were told is 60. So the value of the asset will be whichever is lower between the two. So the value here will be considered to be 60. So this is what we are going to use. So you compare the two, then you go for whichever is lower. Mostly unapatanga fair value ndio inakuanga lower. Because unajua huyu anaona sasa kama analipa mara mingi wakati umeongezeka kitu hapo. So mostly fair value you will find it to be the lower of the two. Alright, so at inception At the inception, you will debit, so you debit, tunaenda, do that as we move. You debit the rights of use asset, 60 million. Then you credit lease obligation. So your right to use this asset is to the tune of 60, and that 60, for you to use it, you will be paid. So you have an obligation also of 60. So at inception, that is what will happen. At inception, that is the entry. Mkianza kupa, that is the first entry you are supposed to make in the books. Then the useful life, they have said the useful life of this asset was 3 years. Something very sensitive. There is the useful life of the asset and the lease term. In the books of the lessee watajuana na hiyo asset for the lease period peke yake. So if the asset is depreciable, then you only depreciate in the books of the lessee, you only depreciate for the lease term. Please get that clear. I've seen it somewhere, maybe tutapata somewhere. The useful life, 4 years. The lease term, 3 years. Depreciation for the lessee is capped at the end of the lease term. So depreciation, so annual depreciation will be 60 million divided by the lease term, they say 3 years. So it will be 20 million per annum. That will be our annual charge for depreciation. That is the annual charge for depreciation. So now, for you to enlist, just like the financial instrument, lease the same. For you to answer the questions of lease, you must prepare what is called lease amortization. It will have all your answers. So let's go to amortization. Let us go to amortization. Every lease must be amortized. So, right for me here, lease amortization. Lease amortization. There. So you write for me here, year, allow me to respond kwani kuna watu wanasumbuka sana kidogo tu. Hello. Hey. Sorry, kuna watu walikuwa wamekwama huko shule. So here, balance brought down. Then there is the, let's talk of finance charge. Let's call it finance charge instead of just calling it interest. 10%. Then the rent paid. Then just give us the balance carried down. Lease, haina maneno mingi. That is the schedule for lease amortization. Very good. So it was 3 years, starting January 2019. So 2019, remember, payment was being made twice every year, June and December. For 2020, also June and December. Payment was twice. Then finally 2021, also June and December. So have that. All right. So rental paid, they were paying 14 million every 6 months. They were paying 14. So once the rent has been paid, it will reduce the obligation. So you subtract. So it is 14 throughout. So installment must be constant. So have that. Once you pay, that must be reduced. Then now the balance, the amount you are supposed to amortize is the one which you had said whichever is lower, which is 60. So here we start with the 60. So 10% of 60, that will be 6. So you will take the opening principal plus the interest minus the total amount which has been paid. What you are paying, part of it will pay principal, part of it will pay the interest. So that should not be your concern. Where you put the opening plus interest minus the rental paid. So that one will be 66 minus 14 is 52. Copy at loan risk. Opening will be 52. 10%. So I will just be going there to Nikimaliza. You will tell me whether your answers are similar with mine. 10% of 52 is 5.2. 5.2 plus that is 57. So this is 43. 200. This is 43, 200. 10% is 4, 320. So 43 plus that minus that one there should give you 33,520. So this is 33,520. By 10%, you get 3,352. Like that. Plus that is 36 minus 14 is 22. 872. 22, 872. Then 22, 872. 10% is 2287. 200. Here's what I was about to find. So 22,872 plus 22,87,200 minus we are 22,872 plus 22,87200 minus 14. 11, 159. 200, 159, 200 by 10. By 10, that should be 115,920. Plus that will be negative, a small negative. In amortization, negative means the whole amount has been paid, so you always write nil. Negative in amortization means the amount is fully paid, so you recognize nil there. So please confirm to me if you have the same figure as mine. For those who are done, just confirm. Mercy corrects. Confirmed, thank you. Now, from amortization, when dealing with the lease, amortization from there is when we can be able to come up with the financials. So I want us to come with the P&L extract here. So I'm in the books of the lessee, JM. So JM Limited, lessee, P&L, profit stock loss, extract. For the year ended, 31st December. So P&L is annual. So check the question. They only wanted for the first 2 years, 2019 and 2020. So 2019, so 31st December, 2019 and 2020. But Good. So extract means give us income and expenses which you are capable of seeing. For the lessee, there is no income. Yeye kazi yake ni kulipa. So expenses, which we can see, depreciation. There was annual depreciation of 2020. Every year, depreciation was 2020. Then another big expense to the lessee is this one here, the interest, the finance charge. So finance charge, you know, they were being charged interest after 6 months, but the books that we are preparing on annual basis. So 2019, you add these two. 2020, you also add those two, like that. Because the charges here is after every 6 months, the books we require for a whole year. So you combine. So that is 11,200. Then this one is 76,72. So those are the only extracts we can see. Please have them. If you wish, you can add, but for extracts, there is no need, provided you give us those figures and the narrations. But if you wish to add, no problem. So that is the P&L. Kindly finish that. Then we go to the balance sheet. So that is done. Let's go to the balance sheet extracts. So for balance sheet, I will write for me the heading, the direct. So write JM, statement of financial position, extract, as at. So me, I'll start because I know it requires some space. So I'll just start 2019 and 2020. So write the heading, then we can start. So there we go. Non-current assets. Assets here yao, lakini they bring what we call rights. Rights of use assets. That is what you recognize in the financial statements. So the right of use, 60. But this right of use of yours is losing value every year. So you less accumulated depreciation. You less the accumulated depreciation, 20. We are charging 20 every year. So when you accumulate, next year you charge 40. Total. Then the last year will be 60. So for the net book value, there. So LBV will be 40, will be 20. Have that. Then we bring the liabilities. I hope that is done. So liability, remember we said you recognize asset and obligation at the same time because you have to pay. So what you have not paid is an obligation. So you come here and say non-current lease obligation also current lease obligations. I have those two. Hizo mbili ndio watu wanapoteaga, so I want your full attention. I want your full attention. So please check here. What is an uncurrent liability? An uncurrent liability is an obligation which is not expected to be settled in the next 1 year. In the next 1 year. While the current is the one which is expected to be settled in the next 1 year. So go back to our amortization table. In 2019, you know, balance sheet, you are preparing at the end of the year. So at the end of 2019, check the obligation. At the end of 2019, your obligation is this one here, 43,200. This is your obligation at the end. So of that obligation, huwezi sema ni non-current yote hapana. Si next year pia kunalipwa. So you divide that obligation into two. The one which will remain unpaid by the end of the next 1 year. So the next 1 year unaangalia 2020. You check ahead because you have closed with 43,200. This table you can project in advance. You know very well out of this 43,200 how much will be paid next year and how much will remain outstanding. So of the 43,200, what will remain after 1 year? If you check the table, after 1 year is after 2020. Out of the 43,200, what will remain is this one, 22,872. So right now in 2019, the long term, what we expect to be long term, out of this 43, what will be long term is 22. So the difference between 43,200 and 22,872 will be paid in the next 1 year, 2020. So non-current, you'll come here and say 22,872. That one will not be paid in the next 1 year. It will be long term. Then get me the difference, please. Can you take 43,200 minus 22,872? That one will be paid in the next 1 year. Get me that difference. Get me the difference between the two. 43,2 minus the long term. The difference is how much? So the difference is current, will be short term. $23.28. So this is $23.28. Total, that's how you're getting the total of 43,200. So you have separated the, ukiwa na deni, there is that part you expect to pay in the short term, and there is one in the long period. So long is the one which will have not been paid after 1 year. After 1 year, you're checking ahead this one. So the difference will be paid in the next 1 year. So the total 43. Let's go to 2020. In 2020, the total outstanding at the end, total outstanding is 22,872. How much will remain unpaid after 1 year? After 1 year, there is nothing will be outstanding. So there is no long term in respect to this amount. So there is no long term. And therefore, the whole amount of 22,872 must be paid in the next 1 year. 22,872 must be paid in the next 1 year. Correct. Unless someone has a question, I want us to go to question 2. Good. Let's go to question 2. Let's go to question 2. I hope that is done. Very good. Let's go to question 2 of the handout. Question 2 of the handout. And I read, it says, a lessor leases out an asset on terms which constitutes a finance lease. The primary period is 5 years, commencing 1st July 2016, and the rental payable is 3 million per annum in arrears. The lessee has the right to continue the lease after the 5-year period, referred to as indefinite period at a nominal rent. The cash price of the asset in question as at 1st July 2016 can be assumed to be 11,372. That is the fair value. The rate of interest implicit in the lease is 10%, of course, per annum. These are annual. Show the accounting entries in the lessor's, actually not, I think Aquadica is good, but it's lessor books, apply requirements of IFRS 16. So here we are dealing with the books of the lessor, the owner of the asset. Actually, when dealing with the lessor, there is nothing which changes. Every step remains the same. The only difference is that when you are talking of finance charge, here you talk of finance income in the amortization. When you talk of rental paid, now you talk of rent received. So everything just remains the same. Something else, lessor does not depreciate the asset. Depreciation is with the lessee. Ukinipatia gari yako on a lease, kama kizo kaha, mimi niende na gari nigonge side mirror. I cannot call you back, Carol, nikwambie Carol, unajua hii gari yako mtu akikimbia nayo huwa inagongwa side mirror sana. That is up to me. I repair that side mirror and the rest. So depreciation charges lies with the lessee, not lessor. Lessor will not incur those costs. So let's start by determining whichever value is lower between the two. So get the present value. So present value, these people are telling us to pay installments of 3 million per year. So it will be 3 million times 1 minus the cost of capital is 10%. So 1.1 raised to power -5, because 10% is per year for 5 years. Divide by 0.1, 10%. So can you tell me that value is based on what principle? Confirmed. The answers you are giving there, Hilda, Joy, and the rest. 11,372. 11,372. 360. Currently, the fair value, these people are saying, 11,372. Zimeachana kidogo sana, but we go for whichever value is lower. Thou shalt not overstate the values of the assets. So here we go to amortization direct. So lease amortization. So lease amortization. Lease amortization. There is something which I want us now to adjust. So right here, balance brought down. Finance. Now we talk of finance income. 10%. We are in the books of the lessor. So we talk of finance income. Then rental received or rent received. Balance carried down. Then what I want us to do, okay, amortization normally ends there. But to save on time, you see the extracts which you are doing there and current liability, current liabilities, you can always bring them here to save time. Though amortization normally ends here. And also by extension, amortization is just a working. It is you are working, nobody bothers with that. Exactly, the financial supervision. So I want to bring here non-current assets. You know, this is lessor. Lessor investment. The asset is for investment purposes. Watu wanachukua wanampatia pesa. Kama ilikuwa lessee, ningeandika non-current liabilities. Then current assets. So you can extrapolate it to have those ones at the end. Good, good. So they started in July 2016. So July 2016 is 16-17 financial year. 16-17 financial year. So allow me to say 2017, 18, 19, 20, 21. Yes. Up to there, 1, 2, 3, 4, 5. Those are 5 years. Then rent, they were receiving 3 million. Please, let's reduce the thousands. So they were receiving 3 million every year. But once you receive, you deduct. You don't tell that person to pay anymore. So balance brought down is whichever was lower. So 11,372. We said let's round off. Let's reduce the zeros. So 10% of this, let's just round off. Let's just round off to avoid a lot of problems here. So take that plus that minus the amount which has been paid. You are likely to get 95,09. So this is 95,09, 10%, 951. We have just decided to round off. So this is 7460. Don't copy my answers. Make sure you are. So this is 7460. This is 746. This is 5, 6. Yes. That one is 75 minus the 3. That should be 5206. 5206. So this is 5206. 521. 2727. Can you finish whether it is coming to me? Please finish the remaining. Check whether it comes to 0. Can you finish the amortization? Mercy, confirm. Mercy, because you have confirmed, as we wait others to confirm. When is the exam? Exam is which dates? Exam, which dates? Fourth and 5th December. Well, that is very near. So there are going to be changes again. We are going to have some changes in terms of our class structure again. I think from next week, we have to discuss. We have to change again the structure. No, December ni karibu. Hiyo exam imeletwa karibu sana. That is too near. But hiyo ni mzuri, at least tutapata time ya kutembea mapema. Kuenda Christmas. Alright, so confirm 2727. 273. 273 plus this is 3000. So that is 0. Hiyo kitu imekaribia. Okay. Alright, sawa. So but we have to obey the content. Hata kama time imefika. Because you see, like now, let's be honest. Unajua hii kitu inakuwa tricky. Kasi na pia saa zingine unatumiza bure. You know how it becomes tricky? You know, if I want to finish this syllabus within 1 month, I can. Yote, I can do it within 1 month. But sasa, kazi yangu itakuwa nimefanya. I can do that first question, then we go to the next topic. But you see, the reason why we had to do this, the first question was in the books of the lessee. What if the student ameambiwa books of lesson? So we have to do the workings for lesson. The reason why I'm going to do actually we are going to do 4 questions. What is going to make me to go to the 3rd question? The first 2 questions we have done, though in different books, but now the first 2, the lease payment was being made in arrears. Mshahara tunalipwa? How are we normally paid? Salary. How do we pay salary tunalipwa in arrears or in arrears? Salary is paid in watu waseme. Watu wa payroll waonge. Salary is paid in what? Arrears or in advance? In arrears. Yes. Yeah, salary is in arrears. So the questions we have been doing are in arrears, means after utilization. But now the 3rd scenario, what if the person is paying rent in advance? There are people hawataki stress na maisha, wanalipa rent in advance. So how will you amortize in case even the determination of present value for advance is not the same as this one here. So we have to, according to Taruka, we have to check payment in advance. The fourth one, we have to check what is called sale and lease back. Niko na shida ya pesa na niko na laptop. I can sell to you my laptop na nikienda mkutano bado nikuitishanga hiyo laptop nikulipe kitu kidogo. It works. So we have to check the scenario whereby you sell the asset, then you lease it back. How do you account for it at the point of sale and at the point of leasing back? So you cannot those four things must be done. Sitaki ati siku mko kwa mtihani, ninyi mnafanya mtihani na mimi niko na stress. Nasema aki wasilete lease back because mimi najua siku wafunga lease back, ama wasilete let them not bring advance because I concentrated on arrears. Nataka nakuwa clean. Hiyo siku hata mkifanya mtihani mimi niko huko swimming. Najua watu washapita mtihani. Haya, so let's fill in this to make our work easier for the financials. So at the end of 2017, the lessor had not received 9509. So this 9509, there is part of it which will be received in the next, and there is one which will remain after 1 year. So what is remaining after 1 year is long term. And from the table, what will remain after 1 year is this one, 74. So this one is long term in 2017. So it means the difference will be received in the next 1 year. So that is 9509 minus 7460. So how much do you get? 9509 minus 7460, you get 2049. So when you add this and this, you get the total obligation. We go to 2018, 7460 outstanding. Out of this will remain outstanding after 1 year. So 5206. So 7460, 5206, 2254. That is current. 5206, 2727. 5206, 2727. 2479. 0. 2727, there will be nothing ahead. So it means this one must be received in the next 1 year. So that will make our work easier. That one will make our work quite easier. So finish that, please. Very good. Very good, very good, very good. So we can answer the questions, the extracts. So write for me, I want to say the name of the lesson. So just write there, profits from loss, extract, lesson. Let's be specific. So the examiner wants for all the 5 years. So 2017 all the way. Of that. Sasa lesson ndio landlord. Landlord ana stress, yeye kazi yake ni kupokea pesa. So they talk of income. Then there is something I really need to tell you. Naenda kuambia hapa sahi. So finance income, that is the interest. So pick this column here. The column of interest, 1137, 951, 746, 521, 273. It only ends there. There is a possible question I can be asked. So the question I've ever been asked by someone, and which is sensible, why am I only saying finance income? Hence there is rental. Kwa nini rent tusiweke kama income? You know, wala hii ya kawaida unaona watu wana rent hivyo hivyo tu. When we talk of a lease, the real lease, in quotes, lease inakuanga more or less of a special loan. That is what you need to know. It's a financing, it's a way of financing. So it's more or less of a loan. And when you receive part of the principal of your loan, in quotes, that is not considered as income because you are just receiving whatever you are given out. So the rental paid or rental received is loan repayment or loan receipts. Lease is treated as a special loan to an entity. So wacha hii ingine unasema na kwa nini KRA wanasemanga tu wanatu tax on. Hapana. Here we are talking on a lease agreement for commercial purposes. You have given a company maybe a motor vehicle to use, and the rest is treated in IFRS 16. We treat that as a loan. So this one here is part of the loan received or part of the loan paid. So what you consider as income or as an expense is this one here, the finance income. Yeah. So that is done. That is done. We want to go to statement of financial position, extract. So SFP, extracts, statement of financial position, so statement of financial position, extract in the books of the lessor. So 17, 18, 19, 20, 21. So for the lessor, we talk of non-current assets. So non-current assets, sorry, not non-current assets. We talk of assets. We talk of assets which we talk of non-current, and we talk of current. They are normally called current investment or non-current investment, whichever. But yet we have non-current and current. So we have the figures. That is why we did this extension. So just pick these figures here. We have everything. So this is 74, 60, 20, 49. That gave us total of 9509. Here we had 52, 06, 22, 54, 74, 60. 27, 27, 24, 79, giving us 52, 06. This one is 0, 27, 27, 27, 27. Here there was nothing. So that is the extract of their balance sheet. I tend to believe you are done because I know you are currently I know your speed. So I tend to believe you are done. So lease payments in advance. Lease payments in advance. Let's say talking about pressure here, nalipa mapema ndio atumia assets. Those are not accountants. Accountants hafai kulipa vitu in advance because wanasemanga the ideal financial management, prolong payments, then shorten the collection. Pesa yako isilale nje kwa layman, pesa yako isilale na mtu, lakini ya watu unakaa nayo kabisa, lakini utalipa. You finally pay, lakini story, but finally you pay. Don't buy that. Now, when the payment has been made in advance, there is nothing serious. In fact, I don't have structured notes for this. We're just taking something small about it, then we check the question. So you say the finance charge, there's no structured notes for this. The finance charge is based on the balance after deducting the advance payment. So when they are paying in advance, so what they have paid, you cannot subject to interest. So the interest, you will charge it after you have deducted the advance payment. That is one. Two, the present value, story is equals to, so you will take the installment here is the advance amount times 1 minus 1 plus r raised to power negative n divided by r times 1 plus r. That is how you discount advance payments. So it's the same like in areas, except this one here. You end up with list over FM, since tuliambiwa hivi. Now this is what we have been doing. And that's how we discount for it. FM ukienda utapata hivyo. So that's how you discount for advance. So only two things you're supposed to know. How to discount the installment, then knowing that interest you charge after you have deducted the advance, because mtu akishalipa ufai kumsubject to interest. Hata bank ukilipa mingi, interest huwa inapungua. Nothing else. Let's go to question 3 of the handouts. Let us go to question 3 of the handouts. Let us go to question 3 of the handouts. Though that is rare, advance in very rare situations. So question 3. CR7, that must be Cristiano Ronaldo, is a manufacturing company, leased a plant from Smart Equipment Limited on a finance lease. The details of the lease agreement are as follows. Date of commencement of the lease, 1st January 2018. Fair value of the plant on 1st January 120. Expected useful life 3 years. Annual lease payment paid in advance 50 million. Annual nalipanga in advance. Mwaka ikianza wao wanalipa ya mwaka, so wanakaa tu. Interest rate implicit in the lease 12%. Lease period 3 years. Residual value of the plant 6 million. Required. Show by way of extract how the above transaction will be reflected by Europa. Huyo mtu alikuwa anafikiria mambo ya mpira. By CR7 in the following statement of profit or loss for the year 2018 and 2019, then statement of financial position. So CR7 leased platform. So CR7 is the lessee. So this is in the books of the lessee. So there we go. One less carry out let's discount present value, we compare with the fair value, whichever is lower. Ukilemewa, mostly BM swali zote nimefanya, fair value inakuanga lower. Unajua ingine wanakuwekea mingi because you are prolonging the payment. So I know I see the fair value to be lower. You know the least questions you have done. So kama utaki stress which ukuanga fair value at your own risk. So present value is equals to the advance payment, they are paying 50 million. Let's work in thousands. 50 million times 1 minus the rate is 12%. So 12% will be 1.12 raised to power negative 3 years, divide by 0.12 times 1.12. Because 1 plus R, yeah, that is okay. Then fair value is 120 million. So what we get here, we say whichever is lower. There. So can you discount for me that? You tell me the figure. You tell me the figure. Hilda, 134,543. 134,503. Whichever is lower is 120. Whichever is lower is 120. So 120 is going to be the right of use, but let's carry out depreciation. So down there you say depreciation. The asset is, we are dealing with the lessee, so the asset must be depreciated. So it will be 120, but of this total amount of 120, there is a residual value. Residual value, they have said 6 million. So we don't depreciate residual value, you subtract. Then you divide by the useful life, which is 3 years. Tell me what you are getting. People are getting 38,000 a year. That is the annual depreciation. Thank you. So amortization schedule, we are going to adjust it kidogo. So right here, amortization. Amortization schedule. So you say here. It started in 2018. So 2018, 19, 2020. Let us be there. When it's getting a different PV, can you share kindly? Just share what you are getting, then we compare notes. When it's getting 120, 091. Okay, whichever is lower than 120, like let's be kusaidiana to discount. Can somebody confirm the 134 and the what Mwende is saying? because I relied on Hilda's figure. So someone to comrades can confirm. Can you confirm kindly? So mwende basi kuna mahali umeenda around because Mercy, Joy, Jenga and the rest. So mwende unafaa uende hivi. Sijui una how ama wacha tuone ile unasema. You forgot to multiply by 1 plus 0. Oh. So mwende you did not multiply by this because of the advance issue. You have not multiplied by 1.12. So multiply by that, then you reconfirm. So as you do that, you will bring the balance brought down. Will bring us the balance brought down. Then now the amortization table will change. How will it change? You know, when it is in arrears means atalipa at the end of the year. So the whole amount at the beginning will attract interest for the entire year. But in this particular advance payment, you don't advance atalipa to reduce the opening balance. So it means the advance payment should come before interest. Interest will be charged on the remaining. After you have subtracted the advance payment is when you charge the interest. So I will bring here the rental paid, which is the advance. The advance payment before interest. Ideally, interest should be based on the opening. But unajua kwanza una reduce that opening is when you charge interest. So some people normally do it offhand. They take this minus this is when they charge. But let's just bring everything. So bringing everything here, I'll say principal balance. But I can confirm you can work without this one here. You can just take this minus this, then you charge your interest. So it's when I bring the finance charge. The finance charge, then I get the balance carried down. Non-current liability, current liabilities to make our work easier. So I repeat, there is no need of even, okay, see as no need. Some people will not show the principal balance, this one here. They'll just take this minus this, then they bring here finance charge. What you need to know when dealing with advance payment, interest comes after you have netted off the rental paid. So the rental, they are paying in advance 50. They are paying in advance 50. So they are paying 50, 50, 50. So balance brought down will be the 120. So if they will pay in arrears at the end of the year, then I charge interest happen. But here they are paying immediately. So you take 120 minus the advance. So what will remain, the 70, is what will attract interest. Interest is 12%. Interest is 12%. So 70 by 12, that should be 84. Wait, what is 12% of 70,000? 8,400, yes. 8,400. So you will take 70 plus 84. Unajua 84 watalipa tena, wao wanalipa next year sasa. So it is 70, you don't come back this side. 70 plus this. That is now what they will have as the balance carried down. 78,400. That will be the balance at the end. Then here, we shall be talking of 78 400 as the balance. So this is 28, 400. What is 12% of 28, 400? $34.08. So 28,400 plus 3408, we are getting a principal balance of how much? Balance carried down. 28 plus that one is 33 or 31, whichever. 31,808. 31,808. So that is what you bring here. 31,808. Payment of 50. So principal balance is nil. There is nothing. Therefore, non-current liabilities, we can derive those figures very fast. Non-current liabilities, 78,400. What will not be paid in the next 1 year is this one, 31,808. So get the difference, 78,400 minus 31,808. 46,592. My space is an issue, but I hope we are together. Haya. 2019, this, there is nothing ahead. So hii lazima ilipwe. 808. Nothing. So for in exam, I propose just bring this principal balance because our marking schedule, so it is your own working. But kama pia utaki ni sawa, provided you know you take the opening minus first of all the advance is when you charge. You are still okay. If it is in arrears, interest comes first. So CR7, lessee, E&L, extracts. They want only for 2 years. They want 2018 and 19 only. They only want those 2 years. So you will give them depreciation annual. You will give them the annual depreciation, and also you will give them the finance charge. So finance charge. Annual depreciation is 38. Finance charge, you pick from the table, 84, 34, 8. Like that. Panga hiyo kazi. Even if it was in the books of the lesson, The same amortization, according to the change, there is nothing which will change. The only things which will change are the wordings, rental, receipt, finance income, non-current asset, current asset. Figures are the same. Good. Let's go to statement of financial position. So because of space, we are making a EOC and 7, statement of financial position extract. So me, I'll just pick 2018, 2019. Non-current assets, you bring ROU, which is the right of use assets, 120. 120. Less accumulated depreciation, 38. Accumulate, 76. NPV, and get them there. Get the net book values. So net book value here, this will be 82, 44 at your own risk. Make sure we calculate. So you proceed down there. I've run out of space. So you write liabilities. Liabilities. So liabilities, you bring the non-current. Non-current. Obligations. Please write in full. Then current. Lease. Obligation. I'm writing in short because of space. Can you write in full? So non-current lease obligation and current lease obligation. Write them in full. And we have everything up here. 31,808, 46,592, 78,400. From this table here. Then 2019, there is no long term, 31,808, 31,808. Up topic. Sale and lease back. Sale and lease back. Ukiangalia layman, hii utasema ni kurogwa, unauzia mtu Eliza, nyumba ni yako, the house is yours, you have constructed your nice home in Nairobi, then you decide to sell this. So let's say video unauzia nyumba yako, unauzia James, unaweza uzia James Kirago hapo. Then once you sell to him, unarudi unamwambia, unajua ukishamuuzia sasa ndio landlord. Unamwambia landlord, sinirudi niishi kwa hii nyumba, nikuwe nikikulipa rent on monthly basis. Naweza rudi hapo ni kulipange rent. Na tayari utalipa. So you sell it, then now again you negotiate with that person, sasa ukue ndio tenant. When you check it on face value, utasema hiyo ni biashara, huwezi ingia hapo. But you will see that by the time we start, utasema it's a good thing to do. So that will be our next. So now, when is our next? Syndication. We are meeting tomorrow. Madam Joy, I hope you are there. We are meeting tomorrow. This one requires, kama ni mingi ni 45 minutes. Tumalize mambo ya lease. Yes, mambo ya lease. Then I see the next topic. So please, from my projections, it can't work. It can't. Okay, you know, what wanatumiza. This thing, we used to do it in, I don't think if that information is necessary for